Welcome to CoreLogic RP Data's update on housing market conditions for November 2015, brought to you by REMAX WA. Last month we saw a further indication that the rate of capital gain is starting to slow down in Sydney and to a lesser extent in Melbourne. Combined capital city home values moved 0.2% higher over the month to be up 1.4% over the past 3 months and 10.1% higher over the past 12 months. The annual rate of capital gain has been easing from a recent peak of 11.1% recorded in July earlier this year. Dwelling values have been rising across our combined capital city measure for nearly 3.5 years now, taking the cumulative capital gain to 32.1%. Of course, most of this growth has been happening in Sydney, where dwelling values have increased now by 50% over the cycle to date. Melbourne's followed close behind, with values rising by 36.2% over the same period. Growth conditions have been much more moderate outside of Sydney and Melbourne, with two capital cities, Perth and Darwin, now well into the down phase of this cycle, while value growth in the remaining capital cities remains moderate over the past year. Over the past 3 months, we've been seeing some interesting evolutions in the housing market. From a capital gain perspective, Melbourne started to show a stronger capital gain performance compared with Sydney. Both markets are showing some moderation in their strong rate of capital gain, but over the past 3 months, Melbourne dwelling values have increased by 3.1% compared to a 1.5% rise in Sydney values. Melbourne's also consistently recorded a higher auction clearance rate compared with Sydney since the second week of September. Another new factor in the housing market is that the cost of debt has recently increased. Due to higher capital requirements implemented by APRA, banks have raised mortgage rates by 15 to 20 basis points without any lift in the official cash rate. Additionally, mortgages for investment purposes are now faced with a 30 basis point premium over owner-occupier loans, which is likely to act as a further dampener on investment demand. Add to this the fact that most lenders are now requiring a larger deposit, and it's clear that borrowers are facing lending conditions that are a little bit tougher than what they were earlier in the year. Auction clearance rates have also continued to ease off, with the capital city weighted average clearance rate falling to 61%, the lowest clearance rate since June of last year. Sydney's clearance rate over the first weekend of November was 60.2%, down from a recent high of 90% in April this year. Melbourne clearance rates have been a little more resilient, recorded at 65.6% over the first week of November. Auction clearance rates have been easing since April, and if the trend continues, we'll see the weighted average clearance rate fall below the 60% mark for the first time since early 2013. The spring season, when listing numbers normally rise substantially, hasn't been as active as what we've seen over previous years. Nationally, the number of properties being advertised for sale is 2.7% lower than a year ago, and newly advertised properties being added to the market are 3.6% lower than the same time last year. Listing numbers have risen substantially in Perth and Darwin, where housing market conditions are the weakest of the capital cities. Sydney's the only other capital city where stock levels are higher than a year ago. Higher stock levels means more choice for buyers, which should help to take some of the heat out of the Sydney market. The Perth housing market is progressing through the down phase of the cycle after recording strong growth conditions prior to 2014. The housing market in Perth peaked in December 2014, and since that time, dwelling values have fallen by 6.2%. Listing numbers have risen substantially, not due to a higher than normal amount of stock being added to the market, but due simply to a lower rate of absorption. The number of newly advertised properties being added to the Perth market has actually been relatively low, but in the face of reduced buyer demand, homes are taking longer to sell, and vendors may need to reduce their price expectations in order to make a sale. The housing market appears to be moving through an inflection point, with the rate of capital growth starting to taper due to a slowing of conditions in Sydney and to a lesser extent in Melbourne. These are Australia's two largest housing markets, and they've been driving the high headline rates of capital gain since 2009. A controlled slowdown in the trend value growth rate in these markets will be viewed positively by the Reserve Bank and regulators such as APRA, who are keen to see the rate of appreciation slow down in Sydney and Melbourne. Changes in the mortgage lending environment are likely to be one of the factors contributing to a slowdown in housing market conditions. Mortgage rates moved slightly higher in October. Investors are now paying a premium on the cost of debt, and banks are generally seeking a 20% or larger deposit for the majority of new mortgage originations. Low rental yields and affordability pressures are also at play in reducing housing market demand. The slowdown in housing market conditions are a timely reminder that home values don't always rise. The most recent downturn in capital city dwelling values was between late 2010 through to mid-2012, when dwelling values reduced by 7.4% over the 20 months. Prior to that, it was the GFC where dwelling values were down by 6.1% from peak to trough, which lasted most of the 2008 calendar year. With interest rates set to remain low, potentially moving even lower next month or into the next year, we'll continue to see a level of stimulus for the housing market that should provide a floor under buyer demand. Dwelling construction is an important part of the national economy at a time when capital expenditure in the resources sector continues to wind down and commodity prices weaken further. It will be important that home buyers and investors remain active at a time when new housing supply is moving through record levels. If the cooling trend continues, we should see housing market conditions become better for buyers. This means more stock to choose from, more time to make a purchase decision, and a better ability to negotiate on the contract price, which will be a welcome change for those looking to buy a home in Sydney or Melbourne, where selling conditions have been strong, but buyers have faced very high levels of competition and rapid selling times for the available stock. As always, thanks for tuning into our monthly housing market update. If you want to stay up to date with your local housing market conditions, check out our research blog, which is updated regularly at www.corelogic.com.au. Detailed housing market reports are also available at propertyvalue.com.au.